Hi, this is Seamus Smyth, Chief Economist here at Burnus Investment Partners, here today to talk a little bit about the underlying growth situation as we came into 2026, how that looks with respect to the Iran war, and a little bit then about how that plays through with the labor market as we go forward. And I guess the most important thing to note about growth through 2025 was it was extremely volatile, and probably more volatile than real underlying growth was. What do I mean by that? Well, you had a measured actual decline in output in Q1, then followed by what looked to be an extremely rapid rebound through the middle of the year, Q2 and Q3, when growth was measured at around 4%, then followed by another very soft quarter at the end of the year. Does that represent what was really happening in the economy? We don't think so. When you look at what was driving some of these big swings in growth, it was things such as big shifts in net exports and inventories, always very volatile components of GDP, but even more so in the environment when substantial changes in tariff policy was leading companies to shift around when they were doing things and shift around when they were doing things in a way that was not necessarily indicative of real changes in the underlying economy, but was more shifts in time. And we can sort of look at some other data to try understand whether that was really what was happening or not. And one way to do that is to look at gross domestic income. Gross domestic income is a parallel measure of overall output from the economy that should, in theory, equal GDP, but doesn't because it's built up from different sources and different methods. If you look at GDI and compare it to GDP, you can see that there was some volatility through the year, but there was much less volatility than there was from GDP. And then if we look even more so, smoothing a little bit over time by looking at the year-over-year changes in both GDP and GDI, they kind of give the same story of gradual slowing in 2025 relative to 2024, with output growing at a little bit over 2% in both of those. We can then sort of think about what's happening as we go into 2026. And when we look at Q1 for 2026, we see more of the same, more or less. We see a bean count, sort of our estimate of GDP built up from the component data we've got so far, that looks to be tracking a little bit under 2%. So a little bit softer than we were seeing in 2025, but not a lot. So that growth of right around 2%, maybe a little bit less in terms of where we're heading, was where we were entering the commencement of hostilities with Iran. So what do we think the likely effect of the Iran war is on the US? Well, as long as it stays sort of where we are now in terms of oil prices, we think it's a relatively muted effect. The US is in a very different place than it was 20 years ago, and in a very different place than many other developed market economies, in that we have a substantial amount of domestic oil production. So when we think about how it plays out, we see a consumer that is clearly hurt by this, that readjusts consumption lower in the face of elevated oil prices that feed through gasoline, heating oil, and all of those things, and pulls back on consumption. But for the US, there's that offset that you're going to see an increase in domestic oil production. When we run through the math, try to think about exactly how do these offset each other, we still get to a modest drag. But as long as oil is in that sort of $100, $110 range, it's a modest drag, call it 25 to 50 basis points rather than a game changer. If we start to get higher, if we start to get up to 150, that goes out the window. That's the point where you start to see nonlinear feedback effects, and you can see really big changes in consumer behavior and potentially recessionary changes in overall behavior. But again, we think it has to get up to the $150 range before we start to really hit that. That's a relatively optimistic story on growth. But when we turn to looking at employment, at least on its face, picture doesn't look quite so good. If we look at employment growth over the last 6 months for the US, it's been basically zero. Maybe seeing a little bit of an uptick over the last couple of months, but still very low. And data is noisy enough that you're certainly not confident that you're seeing an uptick in employment growth. So what's happening here? We continue to think this is, again, policy effects playing through the economic data. In this case, it's the significant changes in US immigration policy that are making a difference. So as a result of changes in immigration policy, we think population growth has slowed close to zero at this point. And with population close to zero, you just don't need to add that many jobs to keep the unemployment rate steady, what the economists call the break-even unemployment rate. We think that's quite low, only a little bit above zero. And as long as you have employment break even around zero, you're going to have lots of months where you have both positive and negative readings on employment, but without necessarily taking a big negative impact from negative readings on employment. And we can see that if we look at some of the ratio based measures that we have of the labor market, ones that implicitly adjust for the fact that population growth has changed. And unemployment rate is the most common one, but one of our favorite ones to look at is the prime age employment to population ratio of workers aged 25 to 54, ones who are generally in the labor force. And when we look at that, we get a pretty optimistic picture, actually. If you look at the prime age employment to population ratio, it's down a little bit from cycle highs, but compare it to the last 20, 25 years, and you're at a very elevated level. You're at a level that is quite strong and consistent with an overall labor market, but again, not quite as good as it was a couple of years ago, but pretty good and not showing any signs of meaningful deterioration as we're going through.